What's up, guys? On this episode of Full Signal, I'm joined by Kevin Gordon, head of macro research at Charles Schwab. We talk about where the stock market is going next year, the government shutdown and the data blackout, whether we're in a recession or a Vibecession, and much more. It's great to get Kevin's insights because he works in the cutting edge of research in one of the biggest institutions in finance. I hope you enjoy this conversation. Kevin, I wanted to get into your big picture view on markets. We just are ending a government shutdown. The S&P 500 could see another 20% year for the third year in a row. Give us your lay of the land here.
Sure. So, I'll say we could be ending a shutdown. Still have to get through the House. I think that as we look to really just a handful of weeks left for the year, my focus more is sort of on how this concentration issue in the market resolves itself a bit. And, this has been a feature of the market for a while, where you've got the 10 largest stocks in the S&P 500 making up somewhere just slightly north of 40% of the index's market cap. That in and of itself is not as concerning to me, because that's been more the feature of this market as the mega caps have grown over time, as they've dominated not just in a price sense, but also in an earnings sense. When I look at concentration risk, I look at it from the performance side of things. So as an example, you look at the end of October, by the end of that month, you have fewer than 30% of the members in the S&P 500 outperforming the index on a rolling 3-month basis. I like to use that window as a gauge of kind of more, near-term outperformance and whether the market is broadening. That share is incredibly low relative to history, that sub 30% statistic. Not in and of itself, sort of an Armageddon message for the market, but what it really exposed was more fragility outside of the Mag 7 or the top 10 or the AI trade, especially as you move up the large cap spectrum. So to me, and I think some of the healthier signs we've been seeing over the past couple of weeks have been this broader consolidation that's gone on in some of the more highly speculative parts of the market. A week like last week was one in which you saw the equal weighted indexes actually catch up a little bit relative to the cap weighted indexes. Both fell, but the relative to performance spread was in favor of the equal weight. So I think more instances like that, where you get a little bit of this cleanse, a little bit more of a breadth, washout and then a catch up, that to me is more important going into the end of the year, because I think that one of the things that has a potential for maybe becoming a little bit of a sore spot for the market is if for some reason you see the cap weighted indexes, pick the S&P 500 as an example, continue to move higher, but you see breadth continue to deteriorate. And the metric I like to use for that is the percentage of companies that are above their 200-day moving average. If both of those diverge, which has happened before, most recently at the end of 2021 into 2022, and it's happened multiple times before many times before you've gotten a bear market, that to me would be more concerning. And I think that's probably the best sort of metric or most key metric, I think, to watch going into 2026.
Yeah, I think that's an interesting point, and it makes a lot of sense how you lay it out. If we see this top-heavy market, we've seen it for several years at this point, is it fair to say, okay, instead of this being a risk, because a lot of people say it's a risk, could we call it the new normal and just get on with it?
Well, it has been the new normal. I always say to people, whether you like it or not, it is what it is. I mean, just look at the math and it just tells you. We've had for a long time now more than a third of the S&P 500 being dominated by just 10 names. And they're not always tech or communication services or discretionary. It's sometimes financials creeps in there a little bit. So it's not just one sector that shares the blame. I think it would be certainly a different conversation if it was just one sector that was having all 10 of those names. So if it was just technology, then I think there would be certainly more of a risk. And the risk, I think, would be more in terms of volatility, where you've got really just a handful or a couple handfuls of stocks that are driving the indexes and driving their behavior. And we've seen more instances of this year in particular, where the cap weighted index, again, the S&P 500 for an example, can go one direction, but breadth in terms of advanced decline, the number of advancing members versus declining members, can go the opposite direction. And that most recently happened at the beginning of this week, where the advanced decline spread was negative, meaning you had more members that were falling that day, but the index's return was positive. So you're having more of those days this year, and in the past couple of years, because now, as you said, it's become more of a feature to see this top heaviness in the market. So I don't necessarily, as I mentioned just a couple of minutes ago, I don't necessarily view it as this inherently negative thing. I think it just is an aspect of the market that should force investors to sort of reassess and reinforce what their expectations are for the market. If you have an expectation of lower volatility and you don't want a portfolio that has a lot of volatility associated with it, then you probably shouldn't be looking as much into cap-weighted indexes. You should maybe take more of an equal-weighted approach. Of course, everybody's circumstances are going to be different, but I think that's one example of how you really need to reassess and reorient your view of U.S. markets in particular, just because of how concentrated they've become and how volatile, the large cap names can be sometimes.
With this concentration that you're talking about, that's led, of course, a lot of people to speculate that, okay, this is just like the dot-com bubble.
Yeah.
And I've pushed back on that many times. I don't think that's a valid argument. I think the companies today are very different profiles than we saw 25 years ago. Where do you fall on that debate?
I mean, I broadly agree with that. I think, when I look, and I'm a student of market and economic history, so when I love studying prior cycles, and what I have found is that there are no two cycles that are the same. No two bull markets are the same. No two recessions are the same. I mean, even if you look at the past 3 recessions we've had in the US, because they've had bear markets associated with them. So there is a market tied to this. But if you look at 2020, a lot of people don't consider that a traditional recession. Even the NBER, which is the arbiter of recessions in the US, they don't necessarily consider that. They had a footnote when they labeled it and when they called it, saying this doesn't really fit the traditional norm for what we would consider a recession. But because of this epic decline in GDP and job loss that we've seen, clearly it made sense to label that a recession. But you had that lasting really just a couple of months. Then you rewind it to the financial crisis, which is the recession that we had before the pandemic. That was an epic recession for not just the US, but the globe. But you also had a pretty epic bear market alongside it. When you go to the recession prior to that, which was in 2001, in GDP terms, the drawdown in the economy was pretty minimal. There was barely a scar. We had a decline, but it wasn't that big. I think of that recession as more of a recession in the stock market because of the boom that we had in the 90s and ultimately the bust, the tech bust that led to a really epic bear market from March 2000 to October of 2002. That's when the S&P 500 finally bottomed. So 3 recessions, 3 totally different sets of circumstances. I think as it pertains to the late 90s and to the early 2000s in particular, I think you're right to point out a lot of the qualities and the difference in fundamentals, and in some cases the actual fundamentals of companies these days. Can there be parallels to it? Yeah, I think that, a bubble is a bubble in terms of, not saying we're necessarily in one, but bubbles have similar characteristics with a lot of hype around some companies that may not have profits, around a lot of hype even around companies that do have profits. Sometimes you can get a bubble in price activity. So at that point, fundamentals don't necessarily matter to a group of investors. But I do think that there are important distinctions just purely on the fact that we know cycles are different over time. Investors' risk tolerance shift over time. The way that technology is implemented over time is also different. I think also the different economic environment and the unique economic environment that we're in right now, I think that also has to be studied. I mean, we've virtually never been in an era or in an instance where you have a significant reduction in labor supply growth and labor force growth, yet the economy is still growing, mostly because of the business investment channel that's been relatively strong. And you have tariffs that are akin to what we've seen in the 1930s. I mean, that mix together already sort of rules out history. So I could keep going, and there are so many examples and so many data points that you can point to. But I think you are ultimately right to point out that there are differences, but that doesn't mean that there's not risk. And that's been our biggest message, is to, at least for our investors and the millions of clients that we have at Schwab, to understand where you could be more at risk in terms of some of these really frothy momentum trades at times. And if those grow as a portion of your portfolio, a large chunk of your portfolio, there's always risk in the event that starts to unwind.
Real quick, we'll get right back to the interview. Just wanted to pop in and say, if you like this content, I write a newsletter every single morning called Opening Bell Daily. I cover macro, the stock market, asset prices, why things are going up, why they're going down. And if you want to get that for free, you can sign up at the link in the description. Let's get back to the interview. Something that I've been looking at as a red flag, I think every bubble has a ton of marketing built into it. And we saw that in .com. If you added .com to the company name, the stock prices would explode. And I think we've seen a similar occurrence with companies coming out and saying, we are an AI company. And a lot of these stocks have just ripped higher because of the name of something. So the marketing around this whole hype cycle, I think is maybe a bit concerning, but that doesn't take away from the fundamental story, which I think is very strong. I want to pivot into the ties to AI to the labor market. Do you see the productivity gains people are talking about from AI? Are those real yet? I know a lot of people are betting on the future that we're going to get those productivity gains, but you have Amazon and other big companies saying we are making layoffs or slowing hiring because of AI. Yeah. What do you make of this?
So I think understanding the broader macro landscape is really key to this because of, the stress of that productivity aspect that you mentioned. The reason that this is so crucial at this point, and I talked about in the previous answer, I talked about this crunch in labor supply growth and labor force growth that we've had. When you take GDP of any country, but especially in the US, since we're here, and that's what I mainly focus on. The function of GDP, the GDP is really just a function of productivity growth and labor force growth at its most basic level. So if you take away the labor force component and essentially bring that to close to zero or just stall speed, you're really relying on productivity to be the main driver. So that's at the most basic level, that's why this has come so much into focus, and it's really come under the microscope. I think that so far, it's probably still too early to say whether that is the case, whether we're seeing these massive productivity gains. Number one, because we don't have the official government data, so we'll have to wait until that's the case, because we're missing a couple jobs reports. But number two, I think that this is also going to be very sector specific, because when you look at the slowdown in labor supply that we've seen so far, most of it is targeted towards sectors that, because of current immigration policy, most of it is targeted towards industries and sectors that are statistically just more reliant on immigrants. So if you're looking at where there are going to be labor shortages and where you need productivity to make up for that loss, I think it's going to be in those sectors like construction and housing and leisure and hospitality and manufacturing and the retail world, which are statistically and historically more skewed in favor of immigrant labor, in terms of immigrant labor making up a larger share of those workforces. I think right now, probably the most acute impact and effect has been on the more professional services industries like financial services, like consulting. There has been a little bit more of a direct impact there, especially at the entry level. But even with that, there's not yet enough data that we've come across to suggest that there are these mass layoff cycles happening just because of AI. I know you mentioned some of the anecdotes with certain companies, which, I don't want to discount that that's happening because clearly it's real. But when you broaden it out and look sector by sector, there's not yet this super strong relationship between AI adoption and then mass layoffs. The St. Louis Fed had some really cool data that they put together and I think came out with a couple of months ago on AI adoption rates and the change in unemployment rates for some sectors. And there's I would say a weak correlation, a positive correlation in terms of unemployment going up as AI adoption goes up, but it's not a super strong relationship. And that really matters, I think, right now, because maybe in the favor of the average worker today, you're not seeing a ton of layoff activity in the aggregate specifically because of AI technology.
Most of the anecdotes in my own life, but also when I'm reading about this idea of a white collar recession keeps coming up. Yeah. And a lot of people point to AI as a driver of that because they're saying, look, if you have a office job, you're going to be very prone to a potential replacement by a bot in some capacity. Yeah. And, I don't know what the data is on that really, like how much percent of the workforce is that really happening to yet? But something that I've been thinking about, if we are seeing like the effects of this at the fringes right now, over time, is it possible that we do see more productive workforce, but a smaller workforce overall?
I'm not, I'm an eternal optimist. So maybe, hopefully it's not just my being naive about things, but I do believe in the concept of creative destruction to some extent, where, yes, if we are eliminating certain roles or if certain pockets of industries, I don't think that just means we're going to get this overall reduction in payrolls. And if you look at a chart of in level terms, non-farm payrolls over time, it's a secularly growing chart. It goes, up and to the right. Yes, you go through periods where there are dips. Those are consistent with recessions. But look, post 2000, after the tech boom and everyone thought that we weren't going to have as many jobs and there were going to be sectors that were decimated. It wasn't necessarily the case. And if anything, actually, post 2000, it wasn't necessarily anything internet related in terms of industries that got completely wiped out. It was, and I wouldn't say this, that these industries got wiped out, but everything manufacturing related here, more on the sort of textile and apparel and footwear end, that's actually what saw the biggest pullback, because 2001 is when China joined the World Trade Organization. That's when we started outsourcing a lot of manufacturing to Asia. And you saw that really clear split. We grew manufacturing jobs in the higher tech and higher end manufacturing, but we lost more in things like autos and textiles and apparel. So it's sort of an example, I think, of how it doesn't always play out how you would think it does. But that's, again, not to say that you're not going to see some displacement. But I think at a higher level, our thinking right now around this is not necessarily that AI is going to be this ultimate replacement of people, more so replacement of certain tasks. And yes, I think that the pendulum is still swinging towards companies that are trying to explore ways to cut down on costs by maybe not hiring people, or in some cases laying people off. But I think back to, at the most basic level for a company to be able to function, people who are in upper and middle management, they have experience from somewhere, being an entry-level person. So I always think to myself, well, if we just don't have entry-level people, how are you eventually going to have people that can run companies? So I think at some point we could see that, and companies could see that the pendulum may be swung a little bit too far, and then there's a little bit of a right-sizing that goes on. What the timeline looks like for that, I have no idea. None of us have a crystal ball into that, but I think that's something that we should consider, especially for some of the white-collar industries that you point out. I think for things, especially like financial services and what I do, data accuracy is everything. Making sure that input, the data that's input for a client account, or for anything research wise that I would do, that matters and is the most crucial thing.
So are you finding that you've been using AI in your own day-to-day work?
I do. I think, we're more in the sort of testing phase of how we can use it, but there are many software applications I already use for research that have it sort of implemented. So I found that from a summary perspective and finding, important data points and contextual stuff, I think that has been helpful. But at the same time, I have found myself having to fact check things at times. And maybe it's because I'm a little bit more biased of wanting to do things on my own and seeing it for myself. I think that'll probably always be, a part of how my brain works. But I think that's another aspect of how this needs to be refined and looked at over time, especially for people in a position like you or me, of looking at things in context, pulling data points that you can't look at a data point for the sake of looking at a data point. You need the context around it. I think that's a really crucial aspect to what we do and anything AI related. If it's going to be pulling that and if you're going to be relying on it, I think understanding everything that surrounds it, that's really crucial.
I think it's a great distinction that you make, that AI can replace tasks rather than jobs. I think that's a great way to think about it. So we've missed a lot of jobs data in the last couple months because of the government shutdown. But I know you've done a lot of work tracking alternative labor market data. Can you walk us through some of that?
Yeah, so there's a ton. And I think in the private sector, what probably gets the most attention in terms of something that's close to the non-farm payrolls report that we get at the beginning of each month is ADP, which has been around for a while, providing private labor statistics for the private workforce. But then also more recently, something like Revelio Labs, which uses a lot of profiles around the country to construct something similar to what the BLS puts out for the jobs report for the first Friday of each month. ADP and Revelio, it's really interesting because over the past 2 months, they've gone in complete opposite directions. So the most recent month for October, ADP showed a gain of north of 40,000 jobs. Revelio showed a decline of 9,000. 120,000. The month before, it was the opposite, where ADP showed a loss and then Revelio actually showed a gain. So I've been thinking about the labor market data, at least, excluding the federal data. I've been thinking about it lately as this hall of mirrors where it's sort of designed to trick you, where not that those reports are designed to trick you, but you can sort of pick whatever data point you want to fit your narrative right now. If you're extremely bearish on the labor market, you can point to Revelio for October. You could say, oh my gosh, we lost jobs. You could point to actually the most recent ADP statistic that came out this morning. They're starting to release jobs data on a weekly basis. And the most recent data point that they have for the end of October was that the economy actually shed almost 12,000 jobs going into the end of the month. You can point to challenger layoff announcements, which really spiked in October. If you're bullish on the labor market, you could point to the fact that, up until this most recent week, if you aggregated all of the state initial jobless claims data, which we still get every Thursday, we just don't get it at the national level. If you were putting that all together, jobless claims have actually remained pretty steady and pretty low. So they're right around that 220,000 mark, which is nowhere near recession territory. Certainly not consistent with what you would see if non-farm payrolls were slipping into negative territory and the unemployment rate was spiking. So you could be bullish on the labor market and just point to that statistic alone, because historically jobless claims, we have a long history for it, but also they're pretty great predictors of where the labor market is going, especially at these really important inflection points. So I think that once we get the official data back, I don't have a sense that it's going to show anything extreme on either end. We get this huge resumption in job growth, but we get this massive, fall off a cliff. I think it'll probably be mostly consistent with what we were seeing, which is a pretty significant slowdown in payroll creation, but not a material or a substantial spike in the unemployment rate. And that package of those two things packaged together, are really just consistent with a significant slowdown in the labor force.
So if I had to put you in a corner and ask, all right, are you bullish or bearish on the labor market based on all of that? Because you could pick and choose, as you said, to tell a story.
Yeah.
Where do you fall on that?
Well, I'll say yes, meaning neutral, because I think that, to have a bullish or bearish call on labor in terms of bullish, maybe saying, assuming that means you're going to see some acceleration in the labor market, and then bearish meaning you're going to slip into recession. I still think that we're sort of right in the middle, where the labor market is largely frozen, where the hiring rate has come down. It's pinned to a cycle low. It's near an all-time low, but also the layoff rate just hasn't picked up. And we've been in this low hiring, low firing. I mean, they're probably tired of hearing that phrase, but that's really what we've been in for the better part of the past couple of years. And I think what's frustrating about the labor market, and I think what frustrates a lot of market watchers about it, is that when you look at it in the aggregate, and just take the unemployment rate as sort of the aggregate for the labor market, it's remained remarkably low and steady for a long time. That is not normal relative to history. You look at a chart of the unemployment rate, it's either going up or it's coming down. And it's either going up quickly, which tends to happen in a recession, or it comes down gradually. That tends to happen in an expansion, where after you work through that labor cycle and that labor excess, and you go through that significant drop in payroll growth, in payroll creation, then it takes a long time for the unemployment rate to start to get back to it's what's considered full employment. We are not in that environment. We haven't been in that environment for the past couple of years. If anything, we've seen layoff cycles in pockets, and it's been on a rolling basis. Your point earlier about a white collar recession in terms of layoffs, we saw that in 22 to some extent in 23. Now it's started to pick back up a little bit. So it's just happening in a rolling fashion, and it's happening under the surface. It's just not strong enough to filter up to the broad level at the aggregate level for the economy to send the whole labor market into a recession.
How come you think there were so many economists in the last year predicting a recession when, even though, headlines will lead you to believe the labor markets are really bad, but unemployment has pretty much stayed muted, I would say, or near historic lows? How do you square those things?
Most of it was, and we sort of found ourselves, at least at the onset, a little bit in that boat too, where we would look at a lot of these traditional indicators that lead the economy, whether it's manufacturing, whether it's consumer confidence, whether it is, the Fed raising rates by as much as it did. All of those at one point from 22 into 23 were suggestive and consistent with prior recessions. The problem is that the unique nature of the pandemic ushered in this massive recovery in services, greater than what most people and economists thought was possible. But that really carried the rest of the economy, even as manufacturing and everything cyclical and everything goods oriented and everything in the consumer world really started to falter. So when you look at the split between those and you do the math, again, services being 70% of the economy and manufacturing being the rest, consumers broadly not losing their jobs, that keeps the economy going on a month-to-month basis. If you think about the stock of labor versus the flow, so take out the number of people who are sort of losing their jobs and who aren't getting hired, just look at the number of people who are employed on a month-to-month basis. We've largely been in a fully employed labor market, for a good chunk of time. So as long as you're employed, you're getting a paycheck, you're spending that money. There may be anxiety as to whether you keep your job, but the fact that you stay employed means that aggregate income growth continues to accelerate. And even as we've seen this disinflationary process, even though, price levels are much higher than they were 5 years ago, there has been a disinflationary process where the inflation rate, so something for CPI, has come down from high single digits now closer to 3%. Very far from the Fed's target. I don't want to discount inflation as an issue, but when you measure income growth in inflation-adjusted terms, it's back in positive territory. So when you have that month-to-month and you have the stock of labor that's still relatively healthy, that helps to explain why the at least traditional recession call hasn't necessarily been the right call. You would need to see that really broad-based, full-blown labor cycle and layoff cycle take place for an actual recession to unfold.
Everything you're saying sounds extremely good about the economy, the macro outlook, even the market. Why do you think that we're seeing these consumer sentiment surveys go so negative in the last, I guess it's been several months now?
Yeah, it's one of the most fascinating, I think, aspects of this cycle. And I've built on my colleague Liz Ann Saunders, and I just wrote about this a couple of days ago. But we built on a term that our friend Kyla Scanlon coined, which is Vibecession. And it was, a few years ago, talking about how, to your point, no recession unfolding, the economy continuing to grow, but the vibe's just terrible. Consumer sentiment down, consumer confidence down, really not recovering. And that's still what we're seeing. So if you look at the two surveys that are most in focus for consumer sentiment and confidence, there's the Consumer Confidence Index that comes from the Conference Board. There's the Consumer Sentiment Index that comes from the University of Michigan. The UMich one gets a lot of flack because there's a lot of thinking that it's more politically biased, and they do have questions as to how you identify in terms of political party, and I think that there's some truth to that, but I don't think that it completely discounts it as a metric that should be looked at and should be tracked. But you look at the trajectory of those indexes, and they're nowhere near their prior highs, even as the stock market has continued to make new highs this year, even as GDP has continued to grow and bounce back rather strongly and impressively from the dip earlier this year. We didn't get third quarter GDP because of the shutdown, but presumably it's going to have a 3 handle. And even though the fourth quarter is going to look weak because of the shutdown, you probably get a pretty significant bounce back in the first quarter. So at this point, this, building on Kyla's term, we're thinking of it more now as a vibepression, sort of a Great Depression of sentiment and consumer confidence, where that really doesn't become a solid indicator anymore for the economy because it has been compressing over the past 5 years. I think if a trend is lasting for 5 years, it's starting to become secular in nature, where the vibes continue to get worse and they're sort of in this despair territory, yet the labor market is largely intact. Not to say that there aren't, pockets of stress, but largely intact right now. And the market, maybe most importantly for people who are watching this on a day-to-day basis, and what you can see every day is the stock market. And the market continues to do well. So there's this massive split. And when I think about the letter K and how everybody talks about this K-shaped economy, I think about it in market terms too, where you can look at an S&P 500 that has gone up considerably over the past couple of years, yet consumer confidence and sentiment that has continued to move lower. So I think of it maybe more now as a feature of this cycle, not necessarily a bug, it being depressed confidence, but a still rising market and a still relatively healthy economy.
I mean, I wonder how much of that has to do with, if you are an asset allocator or an investor, you're making a lot of money in the market.
Yep.
but you may not be the type of person they're targeting for these consumer sentiment surveys. Does that play into this?
Yeah, and it's interesting too, because even if you look at, I mean, there's so many sub questions in these surveys, and UMich asks it and the Conference Board asks it, your general confidence on the market and what you expect the market to do. And even in the Conference Board survey, confidence around the stock market's pretty high. It's not at an all-time high, but you map that with the overall confidence index measuring general, economic confidence, and they couldn't be, in more opposite trends and directions right now. So even within that survey, where an average person on the street would say, yeah, I don't feel great about the economy, they're saying, per that survey, but I feel pretty great about the stock market. So it's interesting when you think about a disconnect between the economy and the market, but the average person also sees that and is sort of embracing it to some extent.
Wow. I didn't know that about the nuances of the survey. How should people be feeling about the economic outlook given all of this? And if you're not in the market, you might be feeling more pain than others.
Yeah.
The investing class, let's say, has done extremely well the last few years. But if the job market is very daunting, you're seeing headlines about layoffs, AI is taking jobs, presumably, or at least it might be taking jobs. How can people think about this?
So, in economic terms, I think understanding, some of the dynamics I was talking about earlier in terms of the labor market largely being frozen right now, I think understanding those dynamics is crucial, especially for somebody who is looking for a job, knowing that the hiring rate is quite low right now. That's important because it sort of, I think, helps manage expectations around how long it would take you to find a job and what the job finding rate is. Vice versa for somebody who happens to get laid off, what we're continuing to see in the jobless claims data, because every week you get initial claims. So the people who are filing for the first time, you get continuing claims, people who continue to file because they can't find a job. So for continuing claims, we're still seeing that relatively elevated, where it's taking longer, and that rehiring rate, so the so-called rehiring rate is much higher now. It's taking longer for people to get a job. So I think again, managing expectations around, and this isn't the case for everybody, but in the aggregate, the data is showing that if you do lose a job, the likelihood of being unemployed for longer is higher right now. And then if you're trying to find a job, the likelihood of just finding one is pretty low. It's not always the case in a cycle. You can have times when continuing claims do rise, but the hiring rate is not as low as it is right now. So it does point again to a little bit of the unique nature of this labor market. But I think, broadly for the economy, understanding also that the base of growth and the sources of growth, it has narrowed this year. And this is so much in the zeitgeist right now in terms of the headlines, but everything AI CapEx related in terms of what businesses have been spending, that has been a significant driver of economic growth so far this year. And I think once we get third quarter GDP, I do think that we'll probably get a pretty healthy bounce back in the consumer spending component, because that was pretty weak in the first half of the year. But so far, it has been a significant driver of the business investment channel. So understanding that is a narrower base of growth, that number two, that has historically actually tended to lead employment cycles where you start to see a pickup in hiring after that. So I think that's something to be on watch for in the first half of 2026. But number three, that's up against a tougher labor supply picture, as I've now mentioned many times. That's what makes this a more unique cycle, where I'm not sure. And what we've been seeing in surveys from what businesses have told us, I'm not necessarily sure that the current CapEx cycle leads to this amazing boom in employment. I think that at the margin we could see it, but I think that there needs to be a lot more stability on things like tariffs. There needs to be a lot more stability on other parts of fiscal policy for maybe that hiring boom to take place. And there's probably a mismatch in terms of the sector stuff that I mentioned earlier, where there's going to be more acute labor shortages versus where that investment is being driven right now.
How does the Fed play into all this? Because I know we may get a pause in December, we may get a cut, but presumably we'll get at least a couple more cuts in the coming months. Yeah. Does that loosen things up meaningfully?
If we get a cut, I think for the large cap multinationals that don't necessarily have to worry about what's going on in the interest rate world, it probably doesn't matter as much. I think though for the broader economy, certainly the Fed has had pivoted at some point, middle of this year, middle to into the fall of this year, where they become much more focused on the labor market. That's evident by the fact that they've cut a couple of times now. Whether we get a December cut, we're still in the pause camp right now for a couple of reasons. One being, if you look at Chair Powell's comments at the last presser, he talked about when you're in a foggy environment, you start to slow down. You don't necessarily go the same speed because of some risks there of moving without having the actual data. But I think number two, and you're seeing this a lot more in the roster of Fed speakers and voters, important distinction there, committee voters right now, because it's a rotating list from time to time, those who are saying that they're not as comfortable easing policy from here or much more from here because inflation is still above their target. It's been above their target for 4.5 years. I think at some point you have to, and what they're saying is that you have to focus on the other side of the mandate, especially if labor is not falling apart. Because the Fed really only cuts aggressively. You could look back in history, it cuts aggressively to save the labor market when the labor market is decelerating sharply. And at that point, it's typically too late for the Fed to do something. I mean, it certainly helps that they accommodate the economy, but the labor cycle has to play itself out, and then ultimately you get, the recovery. So I think that they're still, they've been in a tricky spot. I think they're going to continue to be in a tricky spot, especially heading into next year, where we don't really see, a solid case to be made for inflation coming back to 2%, at least in the near term. I certainly wouldn't think it would happen in the first part of 2026. I could be wrong and pleasantly surprised. But I think there are still enough forces, especially if the labor market stays in its relative, current state, relatively close to its current state. I think there are enough forces that keep inflation averaging closer to 3% as opposed to 2%. And ultimately that leaves the Fed, I think, at or near its current level in terms of the policy rate.
Yeah, I think it's a very fair take, I would say. My last question for you, we're about to see most likely third very strong year of stock market performance.
Yeah.
Could see third 20% year in a row, which is very unusual. Where are we going in 2026 for the stock market?
Oh, well, we haven't released our outlook yet for 26, but I think that, if a lot of these forces that we've talked about sort of stay in their current form, where you can get some churn in labor, but you don't get a full-blown labor cycle, where you can continue to see some productivity gains from everything CapEx related, if corporate earnings stay as strong as they have been, which for the third quarter reporting season, which we're just about to wrap up, was exceptional. And we've effectively doubled the growth rate that was, versus the initial estimate coming into the quarter. It's amazing. So I think if that continues, and earnings are the mother's milk of the stock market. So if earnings themselves continue to look strong, if profit margins look relatively healthy, which they have been so far, there's no reason, I think, to believe that you would see, material weakness in the market. Not to say that you can't experience, significant chop along the way. One of our themes coming into 2025, so about a year ago when we wrote our outlook, was that you were basically going to see a flip dynamic of 2024. 2024 was remarkable at the index level because you had very minimal drawdowns, very minimal scarring. All of the churn and the volatility was under the surface. You look at the average drawdown across the members in the S&P, massive. This year, it's essentially been the opposite, where you have had massive drawdowns at the index level, but you've also had massive, what we call draw ups, the recovery from the April 8th low, and consistent with volatility at the member level, but both of those are back in sync, where what's going on with the average member has been going on with the index, and it's filtered up to that. So I would expect that theme to sort of continue as we go into 26, because you still have a lot that's unresolved on the tariff front. We're waiting for the Supreme Court ruling. You've got a really important Supreme Court case for the Fed that's going to start in January. So I think that there are still a lot of factors that'll be at play in terms of pretty significant volatility drivers. And the last factor I would say would be, the eventual reopening of the government, but us getting clean data again on things like the labor market. We're facing sort of this data hole, HOLE, not WHOLE, in October, where virtually, I think none of that data will be very clean at all because you missed the reference period for payrolls. You basically missed a whole month of CPI data collection. I could go on, but I think that is going to be a really sort of important missing piece of the puzzle, meaning it's going to take us, I think, probably until mid to late January to get a pretty clear read on what's going on with labor. So there's still a lot that could work against the market. But as we've learned this year, I mean, the market can move through it. But I just don't think that means we're going to see minimal volatility as we go into 26.
That's a lot to digest there. Kevin, I really appreciate you taking the time, and we'll do it again soon.
Yeah, thank you for having me. I appreciate it. Thank you.